The price of oil, it's probably one of the most watched numbers on the planet. But what if I told you that number, the one you see on the news, is kind of lying to you? That it's not the whole story? Because right now, oil isn't trading at one price, it's trading at two, and they are worlds apart. Today, we're going to dig into this huge gap, this chasm between paper promises and, well, physical reality.
So check this out. On one side, you've got the price you see on your screen, the futures price, right? Hovering around $90 a barrel. That's the number that markets jump. But then look at the other side. This is the brutal, real-world price a country like Sri Lanka actually had to cough up to get physical barrels to their port, a mind-blowing $286. That's not just a little difference. We're talking more than triple the headline price.
So, the big question is how? How is this even possible? How can one barrel of oil be worth $90 and $286 at the very same time? This isn't just some weird market thing. It's a flashing red light signaling a massive breakdown between the world of finance and the cold, hard reality of the physical world. So let's break it down.
All right, to get our heads around that $90 price, we have to step into the world of paper oil. Now, this is the market most of us know. Even if you don't realize it, it's this gigantic, super fast financial market that's not driven by ships and pipelines, but by algorithms, by expectations, by bets on the future, basically by digital contracts. And the main currency here is something called a futures contract. Look, a futures contract is not a barrel of oil. It's a promise. Think about it like this. An airline is terrified that fuel costs are going to skyrocket, so they might buy a futures contract to lock in today's price for delivery next year. They're guaranteeing they can buy their jet fuel at, let's say, $70 a barrel, no matter what the real price does. It's all about buying certainty.
And this is the absolute key thing to understand. The vast majority of people playing in this futures market, the traders, the hedge funds, you name it, they have zero, and I mean zero, intention of ever actually seeing a physical barrel of oil. They're betting on a number, on a screen. Is it going up? Is it going down? They are trading an idea of oil, a proxy for oil, all based on what they think is going to happen down the road.
For a lot of regular investors, the simplest way to get in on this action is through an ETF, an exchange-traded fund. The big one is the United States Oil Fund, or USO. It's built to let basically anyone bet on oil prices with just a click of a button. So instead of you trying to figure out the crazy futures market, USO just does it for you. It holds a bunch of these contracts. But there's a catch, a big one, a hidden flaw that can really burn the exact people it's supposed to help.
And this number right here, this really shows the hidden danger. We're talking a $64.6 million loss for the USO fund in 2025. And get this was before the crisis even hit its peak. So what gives? Well, the fund can't just buy a contract and hold it forever. It has to keep selling the contracts that are about to expire and then buy new ones for the next month. The problem is, in a typical market, next month's contract is almost always a little bit more expensive. It's like your streaming subscription getting a tiny bit pricier every year. This forces the fund into a constant cycle of selling low and buying high, a process that just slowly eats away at its value. So investors were literally losing money even when the price of oil wasn't really moving. It's wild.
Okay, enough of the paper world. Let's get our hands dirty and dive into the very real, very messy world of physical oil. This is a world of steel, of massive tankers, of geopolitical nightmares. And this is where we find the real story behind that $286 barrel.
So the story kicks off in 2026. A military conflict flares up and basically slams the door shut on the Strait of Hormuz. Now, calling this strait important is a massive understatement. It is the planet's single most vital energy choke point. Period. Every day, something like 20% of all the oil that moves by sea squeezes through this tiny channel. It's the jugular vein of the world economy. And when this crisis hit, that vein was clamped shut. Traffic didn't just slow down. It basically stopped cold, collapsing by an unbelievable 90%.
And the immediate result of that shutdown, 9.1 million barrels of oil per day just vanished from the global supply chain. Poof, gone. To put that into perspective for you, that's nearly 10% of what the entire world uses in a day. Gone, practically overnight. The whole global energy system basically had a heart attack.
With the main artery for Middle Eastern oil completely blocked, the physical crude that was still out there suddenly became insanely valuable. And the cost to just move that precious oil, oh man, it didn't just go up, it went parabolic. Every single piece of the supply chain started to creak and then just shatter under the pressure.
Okay, let's start with the boats, the tankers.
At the absolute height of the panic, the cost to just charter a very large crude carrier, one of those gigantic supertankers, hit a record $770,000 per day. That's not for the oil, mind you. That's just to rent the empty boat for 24 hours.
But wait, it gets crazier. Let's say you somehow manage to get a tanker at that insane price. What happens when you get to a port and it's completely gridlocked with other ships? You start paying something called a demurrage fee. It's literally a fine for waiting around. And that fee hit $310,000 a day. You are burning through over $250,000 for your multi-million-dollar cargo to do nothing. Just sit there. And here's the final blow. Insurance. You can't sail a ship worth hundreds of millions of dollars without it. With the risk of attack in the region going through the roof, war risk insurance premiums shot up by over 1,000%. It got so bad that the big insurers just started pulling the plug, leaving more than 150 ships just stranded with no coverage. It became nearly impossible, both financially and physically, to move oil anywhere near that part of the world.
Okay, so now we have our two completely different stories. You've got the calm paper market betting on a peaceful future, and then you have the absolute chaotic physical market, where just existing costs a fortune. So let's finally connect these two and decode that insane price gap.
This, right here, is the question that unlocks the whole thing. If it suddenly costs an arm and a leg to actually get a physical barrel of oil from point A to point B, why didn't that $90 futures price immediately rocket up to $200, $300 to match reality? The answer is in a market condition that has a very specific and very important name.
And that name is backwardation. Yeah, I know, it sounds super technical, but the idea is actually pretty simple and really powerful. It's what happens when the price for something right now is way, way higher than the price for that same thing in the future. It's the market shooting up a giant emergency flare. It's the system screaming that there is a desperate, painful, right-this-second shortage of the physical stuff.
And this slide right here shows you backwardation in real time. On April 7th, 2026, the price for a physical barrel you could get delivered immediately, that's called dated Brent, hit a record $144. But at that exact same moment, a futures contract for oil to be delivered 6 months later was only trading at $109. That $35 difference? That's the backwardation. That is the huge premium the world was willing to pay to get oil today instead of having to wait. So here's the aha moment. The market was pricing two completely different realities at the same time. That super high spot price, that was the panic, the tanker jams, the insurance nightmare, the desperate need for physical barrels to keep the lights on. But that lower futures price, that was a bet. It was the market's collective guess that this crisis, as bad as it was temporary. The paper market believed that, in 6 months or a year, the diplomats or the military would sort it out, the strait would reopen, and oil would flow freely again. Now, this massive split between a chaotic present and a hopeful future didn't just happen in a spreadsheet. It had real-world consequences, creating a very clear set of winners who cashed in on the chaos and a very clear set of losers who got stuck with the bill. The winners were pretty obvious. Tanker companies, for sure, charging those insane daily rates. U.S. oil and gas exporters also made out like bandits because their stuff, coming out of the Gulf of Mexico, could completely bypass the Hormuz mess and get those premium prices in Europe and Asia. But the losers? They got hit hard. Countries like Japan that depend on the strait for 80 to 90% of their crude were in a terrible spot. And like we talked about, the retail investors in funds like USO, they were often the ones left holding the bag. And the stakes here are just enormous. This quote from Ken Griffin, the CEO of Citadel, really spells it out. This wasn't just some problem for the oil industry. A physical supply shock like this threatens the entire global economy. It had the potential to kick off a horrible recession in less than a year. Turns out, the physical world still gets the final say. So we end up right back where we started, looking at two different prices. You've got the $90 paper price, which is all about what the market thinks or hopes will happen in the future. And then you have the $286 physical price, which shows what the world desperately needs right now to survive. And it leaves us with one really important question to think about. When a real crisis hits, which price actually matters more? The one on your screen or the one at the port?